Okay, yeah.
All right. Good morning, everyone. Welcome to the 2023 first quarter global markets and economic update. Brian and I are going to go through our agenda, which is here. It's a little bit small, so I'll walk you through. As you know, for all of you on the call, we always have an agenda for every meeting we have. And so this quarterly global markets and economic update is no different. We always ask for feedback at the end of our session. There will be a pop-up at the end, 6 brief questions for you to answer. You can do it anonymously. And then on the bottom, giving us feedback how we can improve. So one of the pieces of feedback from our last session was to have the key takeaways in the beginning, review all of our pieces that we're going to cover, and then come back to the key takeaways again. So we've added that structure. And so please give us your feedback and let us know things you'd like to see and otherwise ways for us to improve. Okay, so begin with the end in mind, right? So the key takeaways are, and should I make this bigger? Is it okay? It says it's fit to one page already. Global inflation is declining, going down. However, it's still elevated. We have a number of slides that we're going to walk you through, both in the US and overseas. The slowing global economy is drawing our focus towards corporate earnings, profits, and dividends. That's both in the US and internationally as well, and we'll highlight some components there. International developed and emerging market valuations are favorable to the US. We'll show you some charts in that area. US interest rates are likely to continue to climb in early 2023, and despite a potential recession on the horizon. The Federal Reserve meets every 6 weeks. So what that means translates to 10 times per year. And the first meeting of 2023 begins next week, Tuesday, Wednesday. And so they're likely to raise interest rates again next week. And so we'll cover some components of why and continue on from there. So here's our agenda. We're going to cover the global economy, the US economy, US equities, international developed equities, talk about emerging markets, the overall bond markets or fixed income. Those terms are interchangeable. And then some charts to remember, historical averages, and putting things in perspective. Okay, so let's jump in. We have a combination of charts from Fidelity, JP Morgan, and Schwab. So you'll start to see the different typefaces. Fidelity has an excellent chart that talks about the business cycle. And so here we are in blue. The US is in what's considered a late cycle, moving into potentially a recession. The time frame is undetermined, but we'll talk more about that. And so these are the components. So interest rates are rising. The Federal Reserve rose interest rates by 4.25% last year with all of their different iterations. So credit tightening, policy contractionary. Additionally, I wanted to highlight that sort of China is coming out of their recession. The UK and the Eurozone are a little bit ahead of us, and you'll see some of these highlights in this area. India and Mexico are here and have some sort of positive growth metrics here. Okay, Brian and I are going to sort of bounce back and forth on some charts, but I'll get us started here in the beginning. Okay, so this is a Charles Schwab chart. Global growth and leading indicators, leading economic indicators. So you can see this chart is representing that things are slowing down overall within the global economy. PMI stands for Purchasing Managers Index, which is also manufacturing. Anything below this red line is below 50, which is considered a contraction. What you notice is that in this dark blue, the Eurozone is improving here. Japan in the light blue, you see that improving as well. And the US, however, is in this sort of downward trend. So from a manufacturing standpoint, the US is essentially contracting in this area. Okay. This, Brian, you want to take the lead on this one?
Go ahead.
Okay. So now this is migrating into global unemployment. Unemployment overall around the globe is low. So here we have the US in dark blue. You see it quite low. So here's the pandemic, unemployment going down. China unemployment is quite low as well. We have Japan unemployment even lower. And so the Eurozone is moving in the right direction, but systemically they have slightly higher unemployment than the rest of the world here in this chart. And so part of the, going back a couple slides before, is manufacturing and how inflation is declining. So you have the input prices in manufacturing, you start to see that coming down. And of course, output prices translate in lockstep from there. So overall prices of goods is coming down, and we have some additional slides to show you as we work through the material. And so additionally, during the pandemic, what happened was there was very slow delivery times, a lot of stimulus, people staying home, buying, and things just not arriving because they couldn't be delivered. Well, those shipping times have come down now. Things are more in the, historically over the last, decade plus normal range in terms of delivery time for supply. Okay, so Brian, I'll turn this one.
Yeah, so as far as global inflation is concerned, as you can see here, a lot of the developed markets in the next slide will show a little bit more detail on it. So developed markets overall which is shown here in the blue, as you can see, is greatly increased. And you can see the consumer price index levels of these developed countries, really starting with France on up here. These are all ranging, 6+ all the way up to Italy, which is approaching 12, while the emerging market inflation has remained relatively stable. And you can see down here from a perspective, the exception of Japan, which is a developed market, a lot of the consumer price index of the emerging markets, Brazil, India, South Korea, China, have remained in the mid to lower digits as far as inflation. We'll see a little bit more of this in the following slide. So from a relative basis, another view of this information, as you can see here, is developing. It's got the developing markets and emerging markets separated. From an emerging market perspective, you'll see down towards the bottom a lot of lighter blues, darker blues. That means the inflation rate relative to historical has remained better or been maintained until the end of 22. Where if you look to developed market nations, inflation is high. Now, while it's high, it is, as mentioned earlier, it is decreasing. We are showing signs, U.S. as well as other international developed markets. While it is still high relative to the historical norms, it appears that a lot of the most countries have reached the peak inflation time, and it's starting to come a little bit down as far as the downward trend.
Mm-hmm. Yep, exactly. Everything in this column here, November is a lower number compared to this October read. Okay, so now we're still in the global economy in terms of our agenda, and then covering international central bank policy. Starting with the US. So the Fed funds rate you see is here in dark blue. So all of these interest rate hikes reflect from last year. Then you have the Bank of England, so in lockstep, raising interest rates. And then the ECB stands for the European Central Bank. So the European Central Bank raising rates as well. And then in light blue, you have the Bank of Japan. So Japan has not raised their interest rates. They don't have inflation. So there's been no reason for them to raise interest rates. And then we have the Bank of China. So you see, this is more in the near term, you see China lowering their interest rates. And going back to the first slide where they're coming out of their recession, that makes sense. So there's reason for China to lower their interest rates because they're trying to spur growth after the zero COVID policy they had for the last 3 years. So they've removed the zero COVID policy, and now they're moving back towards more of a growth mindset from an overall positioning standpoint. This next slide, what we're highlighting here is that our Fed, the US, is their plan is to raise interest rates above levels that they think are even necessary to really make sure they stamp out inflation. And then from there, lower interest rates to a more average range. What you see the Bank of England here, no other developed countries are planning this. The Bank of England is planning on continuing to raise rates through this year and level out. The European Central Bank, similar approach. Continue to raise rates as needed, level them out. And then here the Bank of Japan, that here again does not have a lot of inflation. They're planning to just moderately raise their internal rates. In this area, this has to do with stimulus. So during the pandemic, a lot of banks provided a lot of stimulus. And what they're going to be doing in terms of these bond purchases is essentially allow the bonds to mature. They're not going to reinvest. They're not going to continue to buy bonds. And so you see the assets that these central banks are having will just over time mature, and they won't be on their balance sheet any further. Brian, anything I left out?
No,
Last
good.
two? Okay. So now, in terms of our agenda, we're migrating to the US economy. The trend line here, the US average growth trend is 2%. Here we have the pandemic. We recovered from the pandemic completely at one point in 2022, had a bit of a dip here. So you see in the first quarter and the second quarter of last year were some negative results, and now back up towards the trend. We are a consumer-based economy, so you see roughly 2/3 of the economy is driven by the consumer, 17% in government spending, investment in housing, and net exports is a detractor because we import more items than we export. Okay, let's dive into federal finances a little bit. There is a piece in the news about the debt ceiling that I'd like to highlight. And part of our communication here is to avoid the sort of sinking feeling that sometimes an economic bullet point can give you, or something pops up on your phone. So our national debt to GDP, which is our productivity, is just under, well, it's at 97.1%. This chart here from JP Morgan goes all the way back to the 40s. So it's been higher. It can go up, it can go down, and it can go down in a meaningful way. So it is at 97.1. And there's been this discussion about the debt ceiling. Well, how does that made up? Our interest payments. Social Security in the overall budget is 22%, Medicare, Medicaid 27%. So roughly 50% of the budget is between Social Security and Medicare. 14% goes to defense spending, non-defense spending is 16%. So the net interest, our mortgage, our bond payments, is 8% of the budget. Janet Yellen is a very competent Fed chairperson, and I have no concerns about the real concern, which is the US defaulting on our interest payments. That's not going to happen. And so in the meantime, any conjecture about that is just that. It's just hot air. We have a dysfunctional government, and it doesn't seem to be changing anytime soon. So it's just mudslinging that we either have to accept or ignore. But I want you to know that you don't need to be concerned about the US defaulting on the budget, because it's a very, very small part of the budget. Okay. Moving on, this chart highlights an additional component to the federal debt, which is also state and local debt. So here again, you see the federal debt at 97.1% of GDP. Again, it's been higher, but you see the state and local debt levels quite reasonable. We'll get these anecdotal comments about state deficits and things like that. Overall, it's not a big area for heartburn. This is the yield curve. We're gonna come back to that towards the end of the agenda when we review the bond market. Okay. The other piece within the US economy, because we have a divided government, fiscal policy is another name for basically political policy. And because we have divided Congress, one of the pieces to highlight here is that there are not a lot of big surprises, no major policy changes that we would be expecting in the next 2 years. Of the bills that were recently passed, the multipliers in the positive area are here: manufacturing and research and development and infrastructure. On the negative side, increase in corporate tax and individual at the high income level, individual taxes. Brian, anything in the last two charts that I might have left out?
No, not really. I mean, and just really emphasize, the divided government between the parties really is going to kind of keep us in check. I was really don't anticipate any big swing as far as one way or another.
Okay, this Brian, this one is
sure.
maybe...
Yeah, so this is lots of charts here. So we'll kind of start off with the top left. This is a number. This is the really represents the JOLTS versus the unemployment. So this still reflects that we have about the light blue line in ratio to the dark blue is about 1.7. So we still have, even though while job openings have come down, we still have a oversupply of job openings at this time with respect to the number of unemployed folks. So there's still plenty of opportunities. Despite what you hear about tech layoffs and everything else, they're still showing a lot of job openings in the economy. On the lower left, that's just another representation of the unemployment rate. We looked a little bit like that earlier at the global basis. So relative to historical last 15 years or so, we're still at a very low unemployment rate. And on the top right is kind of interesting, as you see, as we went through the pandemic. This is a chart of the labor participation rate for 55 and over and under 55. When we hit COVID, the 55 and plus group greatly fell off as far as job participation. Now, over the last year and a half, it's increased a good bit. Now, granted, it's not at a level compared to pre-COVID, but at least it is increasing. And then you also see then the 25 to 55 crowd that's increased since COVID. It's returned up to levels comparable or higher than pre-COVID.
Mm-hmm. And just as we're going through here, please feel free to add any questions you may have into the Q&A. I have that carved out a separate pop-up on my other screen here, so feel free to post any questions that you have or any items that you want to make sure that we cover by the time we're wrapped up with our session here. All right, Brian, sorry, let me.
So this is once again another chart of unemployment, relative to the 50-year average. We're well below that at 3.7 relative to the average of 6.2. One thing just to note though, while we have had wage growth, and it is still above historical averages, it is downtrending. So this is all important in the sense that it is one of the contributors to the inflationary environment that we've seen. At least what we've seen from a wage perspective, it seems to be cooling off a little bit. So while unemployment remains low and there's plenty of jobs available, at least the wage pressures seem to be waning a little bit as opposed to what we saw a little bit in 2022.
Okay. So this was an interesting chart we wanted to show you on inflation. And so it's sort of there's some pieces to highlight differentiators, for example. So goods you see is coming down. So when we're going to the store, prices are declining here. Energy prices are declining. Of course, fuel prices, we've seen them decline. So the core overall, we see this light blue number declining. Services in this bar chart here, this is actually increasing. And Brian's going to highlight some pieces here. And then rent. This is the other people who are in the apartment space and renting. Rents are rising and rents are continuing in on this trend. And so the piece that we'll highlight further is the difference between goods and services. So Brian, do you want to highlight some of the?
Yeah. So of course, coming out during COVID, when we were people weren't going to restaurants, weren't traveling and everything else, the services demand was very low. So in goods, on the opposite end, goods were in high demand. We had the long lead times. So that trend has changed. So now you're seeing the inflationary aspect of COVID. We're coming out of that, and the goods portion of the inflation is decreasing, while the services piece, while folks are still getting out and traveling, going to restaurants, that continues to increase. In addition to, as most of you probably have heard, with respect to availability of workers in the services industry, restaurants is one of the keys. That continues to be, in addition to, continues to be an inflationary factor, a little bit sticky in the sense that folks are still needing restaurants and other services, still are looking for workers, and then they're actually having to pay them a bit more, historically speaking, than in the past, pay them a bit more than they have, which also increases the inflationary effect of services. So services is still a bit sticky in the sense that that inflation, with the continued low unemployment and lower amount of workers, that's something that we'll need to keep an eye on as far as the overall inflation. But as you can see here, most other factors for inflation have started to fall off.
And so with inflation, we thought we would include this chart from Charles Schwab. Yes, we've experienced high inflation, more inflation than we've had in almost 40 years. The difference between the inflation from the late 70s and early 80s was 10 years. And we had it for 1 year. For last year, doesn't diminish the fact that it was painful. We just thought we would include this to, I don't know, remind ourselves that inflation has been worse in the past, and directionally it is declining, and these rising interest rates that will continue are going to continue to migrate that trend overall in a lower position. Okay, so still within the US economy, this is consumer finances. And so the piece that Brian and I wanted to highlight here is during COVID, there was a lot of stimulus, and at the peak, there was over $2 trillion in cash that people had in their various bank accounts to spend. And that number has come down. There's still just under $1 trillion of excess cash in people's bank accounts as a carryover from COVID. You see the personal savings rate. So as all this stimulus was coming, people were just saving the money because we weren't going anywhere. We were stuck inside, not traveling, not doing anything, and people were receiving income, unemployment, or whatever stimulus checks. There was nothing to spend it on. So now that people have started to spend this money, you see the personal savings rate here on the left-hand side is dramatically declined. And so Brian, you had some comments in this area as well.
So one of the things that's with the bottom chart is folks during the time when folks were getting folks were getting stimulus and everything else, there seems to be a trend of people have gotten used to that level of spending. So hence the savings rate, they've maintained kind of that level of spending while the savings rate will go down. We're also seeing that, like if you see that, we'll see this on the top chart on the right there, the debt service ratio. So folks are, and we'll see this in the next slide as well, is having more debt service on credit cards and whatnot. So in order to kind of maintain that same spending that some folks got used to during the stimulus time, credit cards and other debt is becoming a larger portion of their income. And one thing just to also note on the debt service ratio, this, we've had this kind of 3-year hiatus on the student debt repayment. So that, that figure there may be going up once those payments start later this year.
Okay, we're accumulating some questions, and we're gonna answer these, and I think we can tie it into the overall. So please continue to post your questions here, and we'll be able to. And I think you can thumbs up them if you like the question. You can and we'll make sure that we will for sure be covering each of these. Okay, so here's a chart from Schwab. We're still in the US economy here, but it's showing you in a different way the two different highlights. One is the personal savings rate that's declining here, just because people are continuing to spend as usual, as they had been used to. And then the other piece here is the difference between goods and services. So the price of goods coming down, the price of services continuing to increase in terms of labor. I think more specifically. Actually, we have, so let me, Brian, can you see the Q&A on your side as well? Okay, so Pedro's question, services appear to be increasing, yet their cost of living continues to increase as renting and so on. How much will these factors affect investors? Will this factor into the recession? I'd say, and Pedro, you can correct me if I'm misinterpreting this, but my sense is that it's in the area of the individuals themselves. So like if people are working in the services, they may or may not be renting, they may be homeowners. But people who are renting, they're experiencing inflation to a greater extent. They may feel more pressure to change jobs, which is where the opportunity lies. That in turn puts pressure on corporations because they know they need to pay people more in order to retain them. So indirectly, does it affect the possible recession coming? I'd say a little, but not to a great extent. I mean, labor cost is one of the inputs that companies are seeing, but in terms of, you know, if they're selling products, they can get them for less. So some of this sort of evens out. Like the cost of goods is coming down, the cost of labor is rising. So it wouldn't be one of the key pieces of a potential recession, but it's a friction point a little bit, mainly because the cost of labor is increasing. Okay, Brian, let me let you take this one.
Yeah, so this is, we had a question also on recession. So right now, based on the recession determinants, as mentioned, covered earlier, like from a personal income level, we're still above the rate. We're still doing very well as far as personal income, though as mentioned before, the wages. And then as far as another determinant factor is basically the employment rates. So the non-farm payroll, as mentioned earlier, as covered earlier, that's still employment rate, that's still high. So from some of the key determinant rates, a lot of it regarding employment and income, wages, we're not there yet as far as the recession. There are some areas where we've seen positive real consumer spending, which may, come down a little bit. As far as industrial production, as covered earlier, that's decreasing. So that factor may go into the negative territory. But right now, if you can see on the right side, a lot of the factors, they're really not into any kind of concerning area yet. As the Fed keeps increasing, and as we go into increasing rates, and we go into later this year, we'll see where employment falls, wages fall. So some of these figures may be coming down, but right now, a lot of that, some of the key determinants aren't signaling recession anytime soon. Even though it's all part of the normal business cycle, it will happen. It's inevitable to happen at some point. There's not anything that we see that's on the near-term horizon, at least for the U.S.
And I think that's a perfect dovetail into this question that we have in the Q&A. Do you think the U.S. is indeed headed into a recession? And if so, what's the magnitude we should expect compared to historical trends? So of all the calls that were on between Fidelity and JP Morgan and all these different, major investment corporations, the suggestion is that the recession would be mild. And part of that is because there's a lot of growth and a lot of jobs. And so because we're a consumer-based economy that we covered earlier, and people are in a position to change jobs, get paid more, that is a key positive factor to, okay, the economy may slow down. Technically, it may or may not be a recession. And the Federal Reserve, like we reviewed a couple slides earlier, is raising interest rates just to plan to lower them at some point in the future. So that would be part of the plan to spur the economy if we got technically into a recession. Okay, so now we're migrating to the next bullet point in the agenda, which is US equities. And so we want to highlight this area down here, which is the price of the S&P 500 versus the earnings. So the earnings are in the denominator, price is in the numerator versus the 20-year average. So what you notice with large companies, it's actually the S&P 500 is slightly overvalued to a lesser extent in value, which is where we have things like consumer staples, things that are, things that we'll buy no matter what, versus growth, which is technology. We saw a lot of that during the pandemic, tremendous returns, and then last year, detraction from those returns within technology, for example. And so even after this last year, you can see that growth is suggested even to be overvalued still. And then coming down here to the smaller companies, this is where some opportunities are presenting themselves. And as we think about managing portfolios, and for those of you on this call whose IRA we manage, small cap is going to be an area that we migrate to as we get closer to recession or as we have confirmation of a recession. So thinking of things like moving 2 to 3 chess moves at a time, this is an area that's on our radar, but not an area that we are migrating to currently. And that is further highlighted here. So in green, you have small cap, in gray, you have large cap. So after a market downturn, you see they're about the same. So the tech bubble, -49, -43, 56, 59, global financial crisis, COVID, 33, 40. But then look at the recovery. So you're seeing 61, 97, 126. So small caps lead out of a recession. And this will be an area that we'll be migrating to over the next several quarters as the opportunity presents itself further. Okay. Now, we wanted to highlight some components on the larger US companies. So we are more emphasized in the larger US corporations within the models that we manage, because large companies are positioned to withstand rising interest rates better than smaller companies. And so within that, we're mainly focused on cash flow and profit margins. So how, in other words, dividends, how are those companies managing their cash flow and their profit? So you notice that profit has declined. This is another one of those sort of like clickbait buzz things that I want to preempt you hearing and any sinking feelings that you may have. Profit margins are declining, fine. When you look at the last 30 years, the profit margins are well above normal ranges. So even if, or as profits decline further as we go through 2023, I want you to know that it's well above average over the last 30 years. So if you're finding that, there's some, it's called data mining. That's sort of people who want to get a reaction will take a piece of data that they want to take and present it in a way that they're, wanting to poke. And it's just unnecessary. So I want to let you know that this is an area we're focusing on, but declining profit margins are not an overall concern long-term in this area. Okay. And so within that, staying within US large corporations, what you find when we look at this chart is value is cheap, growth is expensive. So here again, value being things like consumer staples, things that we're going to buy whether we're in a recession or not. Growth more along the lines of technology. Well, you can see it right here, consumer discretionary. And so in this area, we have a tilt towards large cap value compared to large cap growth. but we're still maintaining a position in large cap growth because you see a sector like healthcare, which actually does well in a recession. So there's sort of multiple components going on with overall portfolio construction. Brian, anything I may have left out?
No, I mean, and really this is emphasized, this is the, while we do have that tilt, we expect to continue that tilt as, because those companies tend to be, as referenced earlier, as far as more profitable, the cash flow, the issued dividends. So we'll continue that value tilt, at least moving forward until we see signs otherwise that favor more of a growth environment.
Okay, so here's a chart from Schwab. So deciphering a little bit more the S&P 500 and the different areas that are slightly overvalued. Another confirmation that we're focused in this area in terms of cash flow and dividends, and that's our sort of filtering process for selecting the US large corporations here. Okay. Brian, let me turn this one over to you.
Yeah, so this is really just an indication. Looking at the left, I mean, even though there was some inflation, there's rising costs in 22, sales and earnings growth were still relatively good. Now going into 2023, while there's going to be pressure on growth, I mean, as far as both from a sales perspective and an earnings perspective. So it's kind of a sales and earnings profit recession. They're not necessarily in the negative, but the growth is not as high moving forward. And as we covered earlier, just the general US as well as the general economic, the PMI, the profitability is slowing. The economies are slowing down. The growth and the earnings are expected to slow down as well.
Okay, and so now we're migrating towards international. This is showing that the US valuation is above its historic median. And when you look over here within the international landscape, there's more attractive valuations. And so that's exactly where this chart is going here. So it's showing the international versus the US and the price of overall developed international is 2x, 2 standard deviations below the US from a price standpoint. And when you then look at the dividends are 2x higher than in the US. And that's sort of a natural number because the price is low. With the income and the dividends that they have, it translates to a higher percentage in terms of the actual dividend yield. As international see rising price and recognition and capital appreciation, the dividend percentage will come down. But it's an important component because we're going to be migrating some of our US allocation with US large corporations towards international developed because of this. And then when you look at the valuations, that this blue diamond is the current, and then this gray bar is the 25-year range and the 25-year average. So the US is actually, Brian made a good point as we were preparing for the meeting, different time frames. This is a 25-year average. It's showing it's about in alignment. The highlight being here, where Europe, Japan, China's emerging markets, but overall, the international valuations are below their averages. And similarly, within international, value is cheap and growth is expensive. So the same tilt, as Brian highlighted, that we're positioning in the US, we're doing with international, having a slight tilt towards international developed value versus international growth, for all the reasons suggested here. Okay. Now we're moving into emerging markets and sharing with you the why behind the percentage that we hold within emerging markets. So this is showing the global GDP, global growth. Emerging markets makes up 41% of the global economy. You have the US here at 24% and the remaining components here at 35%. So we have a small percentage in emerging markets, but it's highlighting the why behind having that exposure in that area. Okay, now we're migrating to our last component, which is bonds and otherwise known as fixed income. Those terms are interchangeable. I'm looking at the clock here. We've got a little over 10 minutes left. Please put your questions in the Q&A. We will be wrapped up with some time to answer Q&A, but I'm focused on the 1 o'clock hour to make sure anyone who has something to get to, they're able to do that. Okay, so this is the US Treasury yield curve, December 31st of 2021. And this is a more traditional look at what a yield curve looks like, which means on the bottom, the longer the term, like a 30-year, you'd get a higher rate because you're committing that much more time to holding the bond, and you are otherwise rewarded for that time commitment. Well, this is December 31st of this last year, and what you notice is that in this short end here, interest rates have risen, and this is the highest part of the yield curve. So what we've done within the IRAs, and a lot of you on this call have noticed this, is that we've migrated to owning 3-month and 6-month CDs because they're paying the most. And as these 3- and 6-month CDs mature, we'll renew them likely through the middle of the year. We're going to be hosting this call quarterly, updating you in real time in where things are. And the other piece is that the yield curve is inverted. What does that mean? With this being a typical shape, what you see is that it comes down here, 3.8 at the 10-year. It almost looks like someone's just sitting on the middle of the curve here at the 10-year mark, and it increases at the 20-year mark. What does the inverted yield curve mean? Well, you have to sort of think in reverse a little bit. Imagine a seesaw. You have interest rates on one side, and you have price, bond values on the other. Anytime you have a demand for something, the price is going to rise because people are buying. And then as a result, on the seesaw, the yield, the interest rate goes down. So what an inverted yield curve means is that the price is increasing because people are buying 10-year bonds. The yield is decreasing. And that means that people, the institutions have some fear around a recession. So they're buying those 10-year treasuries because they want to secure that rate. Well, fine. That's helpful information. We are in the 0 to 6 month range. We're nowhere on this curve. We're right here with the bonds that we own. So, Brian, let me pause here. Anything I may have left out in terms of commenting about the curve and what we're doing as a result?
No, and then even for those the non-IRA accounts, the taxable accounts, for the most part, for anybody that's in bonds, we're staying on the shorter end of that. So while we're cognizant of the taxable tax impact, we keep the muni bonds that we keep or tend to be more on the short, especially like high yield and stuff, be on the short end of the curve.
So speaking of high yield bonds, the focal point here is the default rate. So the long run average default rate is 3.5%. As of the end of last year, the default rate is 1.6%. So very, very low default rate in high yield bonds, even though we don't even own them. This is an area we focus on because it's sort of a look through of corporate health. And so you're seeing some of the default rate increasing here. So there is some, sort of concern within this area, but the default rate is significantly below the long run average. But we wanted to include this chart to let you know this is one of the pieces that we look at in the sort of tapestry of the entire investing universe. Okay, now we're moving to the last piece of our presentation, which is charts to remember. And so this is a chart from the Financial Times. On the bottom, you have US stocks. So here's the x-axis here. Moving to the right, you have positive returns. Moving to the left, you have negative returns. US bonds on the y-axis here, negative results here, positive results in this area. 2022 was a tremendous outlier where you have negative stocks and negative bond returns. We have a couple additional charts to show you here. So this is JP Morgan. It's showing you, despite the average intra-year drop, average of 14%, annual returns are positive 75% of the time. So the vast majority of the time, the results that you see within the S&P 500 is this bar chart. Now, in any given year, in any given quarter, we're going to see, or any given month, I should say, we're going to see some red, some negative numbers. Last year, the S&P 500 went down as much as 25%, ended down 19 at the end of the year. And so it was one of the 25%, 75% of the time, you're seeing positive results. Then highlighting the US aggregate bond. Average intra-year dropped 3.3%, significantly less. Annual positive returns just under 90% of the time. So the vast majority of the time you're seeing positive results. Every year there's going to be a dip at some point. We don't know when. 2020 went down 17% and ended down 13% on the year. Very, very rare, significant outlier overall. So coming back to what we started with, what are the key takeaways and how are, for those of you who are managing your accounts, how are we steering the boat, so to speak? Global inflation is declining worldwide, but it's still elevated, moving in the right direction. Slowing global economy draws our focus to corporate earnings, profits, and dividends. International developed and emerging market valuations are favorable to the US. US interest rates are likely to continue to climb early in 2023. Next week's the Fed meeting, Tuesday, Wednesday, so you'll probably see something there. And despite a potential recession on the horizon, and so recession can be anywhere from 6 to 19 months from December of last year. So we're monitoring it. It's not something to be afraid of. It's part of the economic cycle and something that we'll work through and move back into positive territory. So with that, let me pause here. Please put any questions in the Q&A that you'd like us to cover with the few minutes that we have remaining. As we wrap up, please answer the survey. There's 6 very brief questions. They're designed to be brief, but there's a component at the bottom to say, how can we improve? And feedback for us to make the presentation as good as it can be. And again, we're going to be hosting every 3 months. It's the last Wednesday of each new quarter. Now that you've registered, you'll get that reminder. There will be no need for you to register again. And you'll get all the charts and the playback in the follow-up email. So if there are charts that you like, you will receive those charts tomorrow. The email comes tomorrow in a link, so you can download that and save them for your own viewing. So with that said, please feel free to put any questions there. Brian, anything else on your mind that maybe we didn't cover?
No, I think we're good.
All right.
We got one more question come up here. Oh, okay. No,
Thank you.
you're welcome.
Good info and introduction or discussion. All right. We'll give it another minute or so. So if there are any additional questions, feel free to type them in. And Pedro, thank you. We'll give it just another minute, and then I'll wrap it up here, because I do definitely want your feedback. And for anyone who has any questions, feel free to email me. Brian will reply in a coordinated way to any questions you may have as it relates to you more personally. So, all right. Well, having said that, thank you again. And it's an honor. We love what we do, and we're honored to work for you. So thank you. Thank you so much. Bye-bye.
Bye.